Well, good afternoon, everyone. We greatly appreciate you joining us here today. We'll give people just a few more minutes to join before we get started with Cindy and Nick. Just a little bit of a housekeeping prior to that. Hopefully on your screen, you can see a cover slide, supply chain issues. We'll provide a recording of this webinar shortly after the webinar concludes via email. We'll also open up to questions at the end of this webinar. However, Nick and Cindy can also dive into some of those questions as the presentation goes along. You can enter those questions into the question and answer feature on Zoom or the chat feature. Either one is fine with us. Anticipate about 30-35 minutes and then plenty of time for questions at the end. So just a little bit of background here. Whenever we receive a string of questions from our clients where we feel we're not the expert on the topic, we try to bring in those experts. And that's the case here today as we're joined by Cindy Fitz with CISA Insurance and Nicholas Bartzen of Bartzen, Rosenlund, and Kasten. And they're here to discuss the effect that supply chain issues are having on condominium insurance, what that means for your communities, and the best practices to mitigate those impacts. And to sort of set the table for Cindy and Nick here, we've all felt the impact of inflation and supply chain issues when we go to the grocery store. Some of us have also felt that impact when gathering bids or trying to take on major capital projects in our communities. Inflation's at the highest level since 1982. So you combine this with labor and material shortages, and it has a significant impact on prices. So for example, that chart on the bottom right, that is roofing. And it states that roofing has increased nearly 10% since last year. That's triple the increase from the year prior. So with that background in mind, I will turn it over to Cindy to discuss these issues.
Well, as Todd said, thank you all so much for joining us today. Time is one of our most precious assets. And I don't know about you guys, but time has been so limited. So thank you so much for spending your time with us today. One of our next greatest assets, of course, is our homes. And whether you're here as a unit owner, a property manager, a business owner, we're all fighting some of these same kinds of things. And so trying to get back to some of the insurance basics. Because this year it's anybody's guess on where we're going, and especially with insurance, it's just a crazy world, as we know, and insurance is just right on that crazy train. So trying to, again, get back to some of the basics, looking at the Condominium Act, looking at your governing documents, looking at CISA, for reference as to the things that you as an association, you as a property manager should be directing your boards on how to ensure whatever the animal is that we're working with, whether you're a condominium, a townhome, a homeowners association, it's all usually there somewhere. And if not, we need to look to the experts. So first of all, the Condominium Act, of course, is pretty specific on what it requires. It requires a full replacement cost, which means your building's square footage, components, flooring, roofing, wires, pipes, all of that times a factor that today's market value is dictating. We're seeing huge increases on those factors. Like Todd said, just roofing alone is up 10%. We've all been watching the news, I'm sure, and watching the price of oil go up. And that plays into how much our shingles are going to cost. So replacement cost today is quite expensive. Extended replacement cost is that same replacement cost factor plus an additional percentage. So if we agree that your building is a 10 by 10 building, it's 100 square feet. And for simplicity of my math, it's $10 a square foot. So your building is worth $1,000. That's your replacement cost. Your extended replacement cost is then going to add another factor, 10%, 15%, 25%, to cover some of these things that we're seeing today. Increase in supply chain issues with the shingles and bricks and gas and all of those things. Then we have guaranteed replacement cost, which is what CISA provides to our clients, and it's limitless coverage. We might all agree that the building is worth $1,000, but what if it changes? What if these prices on shingles and roofing and blah, blah, blah go up extraordinarily a lot, and you have that total loss? You're going to want $1,000, you're going to want maybe $2,000 to replace your building. So that guaranteed replacement provides that limitless cost. There's no maximums. Townhomes and HOAs, townhomes, depending on how you're insured, whether you're a condominium or you're a homeowner association, you really need to work closely with your agent to make sure that your home's value is priced right this year. Lord forbid you're the one that has that loss. You don't want to be shortchanging your insurance costs. Homeowners associations, you guys are kind of easy, right? As an association, you're insuring the streets and maybe some fencing and a playground. Some of that is much easier to price and come up with an agreed value. We know the swing set costs $1,000. We know the fencing, well, although that could be pretty pricey to replace these days too, especially if it's wood. But we can come up with an agreed value. We agree that your policy limit should be $5,000 and it's based on these things. Please visit that every single year when you're going through your insurance evaluation. Other things that condos are required to have are ordinance and law, directors and officers liability. The Illinois Workers' Compensation Act really encourages that you carry workers' compensation. Umbrella liability and fidelity are some other coverages. I want to touch on the ordinance and law though, again today, especially talking about supply chain issues, because there's three components to ordinance and law. And that first component is dealing with it when you have a covered loss, dealing with the undamaged portion of the building. At some point, a city, a village, a town is going to require that the building be completely demolished. So they're going to say there's only 25% left standing, no good, knock it all down. So that's what that first part of ordinance and law is dealing with. And the Condominium Act requires that that be the full building limit.
Cindy?
Yeah.
I'm just going to break in. I'm sorry, just because,
No.
just for the audience, Cindy's bringing up all this great information, but I think we should be clear. I practice law in the state of Illinois and Cindy works in the state of Illinois. So when Cindy's referencing the Condominium Property Act, we're speaking specifically in terms of Illinois, not to, set aside the Wisconsin participants who are on this call, but in general, if we're referring to the Illinois Condo Act or the Condo Act in general, or CICA, the Common Interest Community Association Act, we're talking in the framework of Illinois, just so everybody's clear.
Great point, Nick. Thank you so much for bringing that up.
Sure.
So the other two components then of ordinance and law are dealing with demolition of the building and increased cost of construction. The Condominium Act requires 10% of your building limit or 500,000 of coverage, whichever is less. These are very, very important again this year because we just don't know where prices are going. And I see so many of my competitors saying, oh, we'll just throw 25,000 at that B and C and we're going to combine them. And then all of a sudden you need the heat shields on your roof and you need, different kinds of wire or something. And if you don't have the right coverages with your insurance, your association is paying out of pocket to rebuild. So really, really important factors with this. At the end of the presentation, Todd's office is going to send out the recording. There's actually going to be a document that I'm providing that shows the 2015 Condo Act changes. And why am I talking about that 7 years later? Because it outlines all of these coverages that I was just mentioning. And so you can just hand that to your agent and say, do I have this? Do I meet these requirements? And if not, why and how do I get it? I just really encourage that, especially this year. So Todd, we can go to the next slide then. And here is why. Building values this year are increasing at an extraordinary rate. I've been doing this for 20 years, and this is the first time in my career that I've seen 30% increases on a building value year over year. Again, some of my competitors just automatically put in a 4% building limit increase. And if you end up with that catastrophic loss and your agent only increased your building value 4% from last year, again, I worry that you'll be paying out of pocket for some of those loss repairs. Some other things that we're seeing this year are the increased use of wind and hail deductibles. And it's just interesting because that takes a percentage of the loss and charges you that as your deductible. So if you have $1 million loss and your wind hail deductible is 2%, your out-of-pocket deductible for that loss is going to be $20,000. Most of us are looking at policies and looking at our $2,500, $5,000, $10,000 deductibles. But that's where the catch is on those wind hail deductibles. So just be aware if you have that. And also be aware the $1,000 deductibles are kind of going away. We aren't seeing those as much anymore. Carriers just aren't willing to take that huge burden. They're asking their clients to do it. And part of this too plays into the material availability that we were talking about. If you're working on building upgrades, which you absolutely should be, I think that's great and it's important. And if you're ordering windows now to be put in this summer and you have to wait 5 or 6 months for those windows to come in, as I've heard some of the horror stories being told, that's okay because you're upgrading. You're doing those important improvements to your association. What if though you're the one who had that huge loss and you have to mitigate some of your damages and you have to repair those components that were lost? The price of plywood, the price of 2x4s. Try getting a cheap generator these days to run your building. It's just so tough and expensive. And again, that's where it's really important to understand what the components are of your coverage right now. What is covered in that replacement cost? What is covered in that extended replacement cost? I also heard yesterday, I don't know, Todd and Nick, if you guys, caulk is like hard to come by. If you've got caulk, you could probably sell it on eBay for like $100 a tube now or something.
No. I'm gonna go check my garage right now.
I know, right?
Mhm.
I mean, it's just the things that are hard to find are really tricky. But again, building valuations are going up because of that cost of wood, because of the oil that goes into making shingles, because of the gas that the truckers need to get those supplies to the store, to your premise. We're just really seeing huge things, and we're working. Many people aren't working. We're still getting back into opening our economy. So it's really tough when you hear me say, okay, make sure you plan for all of this when you know your association is hurting. So don't think that I am not sympathetic to that, but hopefully this will at least help you prepare in the event that you are the one with the loss. We can move on to the next one, Todd. Some other things that are really up and coming are the new insurance requirements. And we're seeing some of this being handed down from Fannie and Freddie. And I know Todd's office is going to have another presentation on that in next month. So I'm not going to spend a lot of time laboring on that point, but just again, start to familiarize yourself with some of these changes. We're looking for verification of structural integrity. You know, how old is your roof? When was your last roof inspection? How about tuck pointing? When was the last time you checked that? Updating the antiquated systems, you know, old aluminum wiring. Aluminum wiring is just about impossible to insure these days. We have one carrier that was doing it, and yeah, they're getting out. They just don't want anything to do with that. And fuse boxes, I had no idea, but those are on their way out too. They want everything updated to breakers. You know, again, be aware the requirements for a reserve study, they're coming down the pike. We'll see. I know our CAI ILAC group is working with the legislators on making sure how those reserve studies are going to be required and handed out. So we'll see what we find out. Loss control inspections. CISA has always done loss control inspections, but more and more of my competitors are also starting to do it, going on premise, verifying what you say is there and true, and doing valuations. So yeah, be aware of that, and doing your engineering reports, making sure you understand what your components are, when they need to be replaced, and why. Some of these insurance requirements, there's going to be a second handout that Todd sends you from me, and it's just a list of things that CISA has been surprised to find out and changing. So, okay, Todd, one more. And wait, there's more. One thing I heard from another person I spoke with, and I thought this was fabulous. Make sure to budget at least one insurance deductible per year. I just thought that was one of the best pieces of advice, because even if you are one of the lucky ones that only have $1,000 deductible, do you have that money available? Where is it? Is it allocated in a reserve for something else? Do you have to go through that legal process of making sure how you're switching that money around? So if you're budgeting that, at least it's something you're aware of. And then you can move it to the next year, because you're an awesome association who doesn't have losses, and you just keep carrying that forward. But in the event you need it, I think it's really important to have it there and talk about it. Remind your unit owners of the association's insurance deductible every year. There is a coverage on personal lines policies. I'm not a personal lines agent. I don't even do my own personal insurance, but there is a line on personal lines policies that's called something like loss assessment, depending on who you work with. And if you're in a situation that your association is charging you back as a unit owner for a loss you've created, like overflowing your bathtub, leaving that cigarette burning in your bed and burning down the building, you want your insurance company to pay that deductible. You don't want to have to pay that $2,500, $5,000, $10,000 out of pocket. Make sure you talk to your agent about that. And associations requiring proof of unit owner and renters insurance coverages every year. So important to help your unit owners stay on track. And Nick, I don't know how you might feel about this, but I always tell the boards, don't manage it. You know, it's not up to you to work with your unit owner and say, oh, no, that's not the right coverage. That's between the unit owner and their agent, right?
Absolutely. Yeah, the association sets the minimum. Everybody needs 300K in liability, 500K.
Yeah.
Show us the proof. That's it. We don't really, that's it.
Yep. Yep. Don't argue with them. All you're doing is asking for proof. And same thing, make sure your renters are getting you that, because statistically speaking, renters cause more losses to associations than unit owners. So we want to make sure that they have insurance to pay for the things that they're causing too. One other thing I think is really important when we're talking about this proof of insurance, I'm worried that we're going to start seeing foreclosures like we did about 10 years ago. Now that the moratorium has been lifted on, evictions and those kinds of things, I'm a little concerned that we might be heading back into seeing a higher amount of foreclosures. And in which case, many times you as an association are taking over a unit and trying to recoup your rent and assessments and those things. So be aware when your association does that you should be adding improvement and betterment coverage with your association insurance agent for those units that you take possession of. Because again, if you have a renter in there who causes a loss, who's going to pay for the difference between what the association is supposed to insure and what the unit owner is supposed to insure? We know our unit owners in foreclosure. I highly doubt they're paying their association renters or owners insurance. So we want to make sure that somebody's got it. It's not very expensive to add it onto your association policy. So I think that one's really important. And again, with these tips, please invite your insurance agent to your meeting. I love Zoom. I'm not driving to the city. I'm not driving all over the place, but I can jump on a meeting at 8 o'clock at night or on a Saturday morning, have a little coffee clutch and just meet with you and talk about your insurance renewals, talk about what's going on with insurance, going through just some insurance 101. I love doing that. And I think the more you as an association know, you as a property manager know, the more valuable we are together, the more we're partners. So I just, please invite me to your meeting. And then just last, if you haven't already gotten your insurance renewal, you can expect your insurance costs this year to be up a good 20 to 30%, which is painful as an agent to be sending it to you. And I know it's painful as an association to be receiving that. Your budgets are already in place. You probably budgeted for a similar amount of insurance that, the increase you got last year. So please just be aware and I don't know, hopefully it works out easier. So that's some of my, yeah, go ahead.
Cindy, real quick, we've got a question about should the board have a copy of unit owners renters insurance?
Yes, please.
Very good. Very good. There's also a question, Nancy, your question about D&O liability. What exactly is the question?
I think Nancy's muted.
I took her off mute. That's okay, Nancy. If you could just enter in the.
Can you hear me now?
Yep, we can hear you.
Okay. Question that I have is relevant to obviously director and officers liability insurance, because the directors on the board are responsible for the management or mismanagement of funds. When you have a property manager and you have an operating account, who should have access to that operating account to assure no mismanagement of funds are occurring? This might be a Nick question.
Go ahead, Nick.
I can jump in on that. Hi,
Thank
Nancy,
you.
how you doing?
Hi.
And before I get to that, I know it was your question on renters insurance too. Now I have to be the persnickety attorney
Okay.
saying, well, it depends, but it does depend. I just want everybody to be aware. This last slide that Cindy put up is excellent. These are all fantastic tips.
Right.
But I just want all of the associations, in Illinois at least, to be very aware of this fact. Renters come into the association, and Cindy is unequivocally correct here. Renters cause a lot of damage to buildings. Ultimately, however, the association cannot put the same requirements on renters that it can on unit owners. The Condo Act in Illinois is absolutely clear. You can make any unit owner maintain a specific amount of liability insurance coverage. And that liability coverage, which to Cindy's point, should include the association's deductible. Hypothetical, my bathtub leaks, it leaks into 4 units below me. The association has to file a claim. It's got a $10,000 deductible. The association's coming after me for that $10,000. And it doesn't care if I have insurance or not. The association, it makes no difference. I have to pay that $10,000. So I, as a unit owner, should absolutely, in my own homeowner's policy, make sure I have coverage in case my bathtub overflows or the cigarette in the bed, etc., I cause damage, that I have that $10,000 in my own insurance coverage to say to the association, here you go, here's your deductible. I know you're taking it from me anyway, it's on my monthly statement, but at least my insurance is going to make me whole there. So what with renters, however, if a renter in my unit causes that bathtub leak, I, as the unit owner, am responsible for that $10,000 and everything else.
Absolutely.
The association cannot go after the renter, at least in Illinois. We have no privity of contract. We've got no, we don't care. It's better for the association to go after me as the unit owner because they have this outstanding leverage over me. They can lien my unit and take me to court to collect it. So the association telling me to have my own renter in there, have renter's insurance, is the association being nice. Legally speaking, the association doesn't care if they have renter's insurance, but I agree with Cindy 100%. The board should be telling people, please, 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 if you are leasing your unit to someone, don't take, make sure they have renter's insurance to cover themselves. If they leave the bathroom leaking, the renter's insurance should be in place. So anyway, I just wanted to touch on that. Nancy, to your point, the D&O coverage, it's extremely important. A really quick primer to everybody here. D&O coverage stands for directors and officers. As Cindy stated, Section 12 of the Illinois Condo Act requires directors and officers insurance for associations. It effectively is the break glass in case of emergency insurance in case the association gets sued, specifically the board of directors. Right. Nancy's point is well heard. If something goes wrong at the association, whether it's the manager or the board, they're all going to get named in the lawsuit. I'm suing the ABC Association. I'm suing Nancy Schickhoff and her whole, board, and I'm suing the property manager. The thing about the manager, Nancy, is even though they get to control the association's money.
Well, what do you mean?
I'm sorry?
I'm sorry. My understanding is that the board, to president and treasurer, are usually the signatures on the operating account. I mean, how can a board control an operating account if they don't have access?
Well, the board should always have access, but other parties have access too. If you have a professional management company, that management company has access to your operating funds. In fact, they're probably holding your operating funds in a banking institution of their selection. They need to be able to write checks on the association's account. Otherwise, why would you have them? Who's paying the gas bill? I mean, otherwise you're just self-managed. So yes, the board should be able to sign checks for large deposits, but your management contract with whomever your managing agent is probably says they're allowed to spend $1,000, $1,500 without any further authorization from the board.
Well, there's been problems with that previously.
Well, we can get into that. I mean, if you have problems with your management company, that's going to go to an issue.
No, I'm talking about previously, historically. There's been problems in that area. Yeah.
I missed that last part of the question.
Historically, there's been problems in that arena, and based on previous consult with a couple of HOA attorneys, they have said that the president and treasurer should really be the signatures on that account and should approve all invoices that go through.
Yeah, that's good guidance. I don't want to get too far afield of what the thrust of this conversation is,
Sure.
which is, in fact, we have to stay on point with this is supply chain discussion. But let
Right.
me just put a button on this very briefly.
Sure.
Your directors and officers insurance, if there is a lawsuit, would cover not only the association, but also the board and the management company. If you have an agreement with a management company, that company is saying, hey, association, if we get named in the lawsuit, you're paying the legal fees. Unless we've gone way out on a limb and broken the law or acted in a wantonly or reckless manner, the association is covering our legal fees. That's why you need the D&O coverage. I don't know what the state of Wisconsin has insofar as legal requirements, but in Illinois, you have to have it. And if you don't have it, to put it bluntly, you're not doing your duty as a board. It's just bad policy.
Well,
So that,
and And additionally, Nick, when we're talking about money, we're actually talking about the fidelity insurance, right?
Yes.
So
Right,
D&O is for decisions and indecisions the board makes, and then fidelity is what protects your money. I'll tell you another hot button this year, and Nancy, so good that you mentioned this, is associations who allow their property manager access to their reserve funds. I have many carriers who won't touch it. So there's a very separate
Right.
line. They
Right.
can
We
have
get that.
access to the everyday operating budget, but not the reserve fund. So I think you're asking really great questions to clarify that, Nancy.
Yeah. So staying on topic here, let's talk about what if we cut corners? Long story short, you can't. You're breaching your fiduciary duty. I keep saying this term, but the fiduciary responsibility of the association is effectively saying, hey, you board have to put the interests of the association above your own personal interest as homeowners, above all else. And part of that fiduciary duty is complying with the law. So cutting corners, it makes absolutely no sense. You're violating the law, you're potentially breaching your fiduciary duty, and you're putting yourself and the association at risk. Now, Todd, we can probably jump to the next slide here. In the vein of what is part of our fiduciary duty, let's think back to everything Cindy has gone through here. Prices have jumped astronomically. We should have named this presentation, let's scare the bejesus out of every participant, because that's effectively the road we're going down. And we don't want to have that be the case. But when you're doing your duty as a fiduciary, it's your job, you property managers, you board members, to be on webinars like this and learn, hey, down the pike are going to be some very large increases in insurance costs, insurance premiums, insurance deductibles, and supply chain costs. What are we doing to make sure we're abreast of it? Coming to a webinar like this is staying abreast of it. Getting a reserve study is staying abreast of it. Talking to your insurance agent and having a cup of coffee with Cindy on Saturday morning during your board meeting is staying abreast of it. That's doing your fiduciary duty. And knowing that these prices are going up is all part and parcel with performing that duty. The next step then is actually increasing assessments to keep pace with these inflationary costs. If you just let everything lay as is and say, well, I don't want my neighbors to hate me, we're not going to raise the assessments, in fact, we're going to drop them back, etc., you might get dinged as a board member for not performing your fiduciary duty. So think of everything, bring together and synthesize the information Cindy gave you here in the outset of this presentation about all these costs, and think about, what do I have to do to make sure my association is on good footing? As an association attorney, I'd say, is your budget keeping pace? Do you have a reserve study that tells you how to plan for all of these increased costs, what your roof's going to cost in 4 years, how to save for the boiler replacement in 6 years? Doing that is not only good practice for your fiduciary duty, but it's also just going to make the association more attractive to potential purchasers. We're all doing this under this giant shadow of the Fannie Mae, Freddie Mac requirements. I'm not going to go too far into that because, as Cindy said, Todd, is that correct? Reserve Advisors is going to do another webinar on Fannie and Freddie coming soon.
Yeah, that's correct. At the very end of this, I'll note that a little bit about that next webinar. Yep.
Okay. Well, just to touch on it, Fannie and Freddie, which insures about 60% of the mortgages out there, they're not interested in backing mortgages for associations that have decided we don't need a reserve study, or we're not raising assessments, or we're going to have to do this enormous special assessment. I mean, that's painting in very broad strokes. Obviously, you're still going to get loans, but you might not get certain financing or certain lending institutions to say, yeah, sure, I'll give you a loan to purchase in this association. Once they learn that the association has not performed its duty to get the mandatory insurance to cover itself in the case of costs that are going up in the world, and having a reserve study. It's just, again, all within this awning of doing your fiduciary duty as an association. And part of that is having a reserve study. Todd, Todd, we can go to the next slide. Actually, I'm just going to touch on a couple of these questions. This is a quick one from Nancy. Reserve study, or do you mean reserves? Nancy, the answer to that question is a reserve study is actually, Todd, do you want to answer that? What a reserve study is and how it differentiates itself from just the reserve account in an association?
In very general, brief terms here, a reserve study, it provides an opinion of the annual recommended reserve contributions required to fund the reserve expenditures. And obviously, when you start that analysis, you start with the pot of reserves an association has set aside for future repair and replacement. That's your starting point for your cash flow. So that study provides the annual reserve contribution recommendations to fund the reserve expenditures.
There you go. That should answer what Nancy, and probably I should have been more clear on that. I'm looking at the open questions, and this is probably a good one for you, Cindy. Anthony's asking, actually, Anthony, how you doing? A question on regarding replacement costs. How often should managers be ordering appraisals on the property? Current property hasn't had an appraisal done in 5 years. This goes to what you were saying, Cindy, with regard to insurance companies coming out and looking, correct?
Yes. And, Anthony, I don't know is my answer to that. Because I'm not in the appraisal end of things. At CISA Insurance, we send out our loss control inspector at least every 3 to 4 years to reevaluate the building. Every year we're running our new CoreLogic or Marshall Swift Beck's report that gives us that updated valuation. So I think the rule of thumb used to be every 5 years from what I remember, but I honestly, I don't know is my answer. Nick, what do you tell your associations? Todd?
How often to get appraisals?
Yeah.
I generally leave that as legal counsel. There's nothing in the Illinois Condo Act that obligates an association to get an appraisal. So if I'm just keeping well, this is what the law requires hat on, I'd say you're not required to have an appraisal. But to Anthony's question, a seasoned good manager is probably thinking that through, as are the seasoned boards.
Right.
What is our property worth? What is the insurable value? What's the replacement value, et cetera? An appraisal makes sense not only for that, but also for lending requirements potentially. So every 5 years might be a good rule of thumb. I can't give you a definitive answer on that though, Anthony. It would be a question to probably speak more with, your insurance professional and think about the particulars of your property. I think if you've had one done in the last 5 years, you're probably better off than 2/3 of the associations out there.
No kidding. And the nice thing about the appraisal too is it gives you that overall square footage. So you always have a basis for knowing. You can then ask your agent, okay, we have $30,000 in square foot in our building. What's the going rate this year? What can we expect? So you can always, back into it that way.
Absolutely. This slide's pretty quick. I asked the hypothetical, what happens if we punt on maintenance? And everybody's here looking like, Nick, why would we do that? Nobody's going to do that. Well, you'd be surprised how many boards do that, because punting on maintenance is effectively, it's politically favorable for boards to do. They like doing it to some extent because not only are they as the boards perhaps not doing their fiduciary duty and saying, well, I don't want to have my assessments increased. I don't want to do the repaving project this year. I'm going to sell in 2 years. So what's the difference? Well, there's a huge difference. That's really all you're responsible for as a board of directors, maintaining the common elements. Punting on maintenance is just not good practice. It's not a fun job to be on the board of directors. We all know that. It's an unpaid position. You are vilified by certain neighbors because you're sending violation notices, increasing assessments, etc. But that's just life in the city, folks. If you're on the board, you have to act as a fiduciary, and you have to bear in mind that maintenance costs are going up. The sidewalk needs to be repaved, the roof needs to be redone, the windows need to be replaced, and you have to budget for it. It's a tough job, but somebody has to do it. So sometimes you have to make politically unpopular decisions as board members, and you have to spend the money for the reserve study. You have to plan for those costs, and that means raising assessments. And as I said, Fannie and Freddie, they just upped the ante, these new requirements. You know, all lenders are going to be asking about this more and more. They're going to want to know how much you have in your reserve account. That's different from your operating account. Your reserve account is your rainy day capital expenditure fund, how you spend your money for capital improvements, etc. They're going to want to know that. They're going to want to know how much you have in delinquencies. They're going to want to know if you have a reserve study and a funding plan, etc. So even if the loan, you know, I'm coming in to buy Cindy's unit at the ABC Association, most of the lenders I would get to give me a loan to buy in the ABC Association are going to send Cindy's association, where I plan on buying, a questionnaire asking about all of this. And if the board doesn't have good answers in place, it's going to tick off Cindy because she's not going to be able to find a buyer for her unit. Talk about politically unpopular, you know, right there. Unit owners who can't sell because I'm going to look down the street. Oh, my lender doesn't want me to buy at ABC because they don't have a good financial planning. They don't have a reserve study, etc. That's not good for the association, legally or politically.
Speaking of that Fannie and Freddie questionnaire, we wanted to, January, February, literally about everybody was doing a presentation on Fannie and Freddie. And we wanted to wait several weeks until after that announcement of these new guidelines occurred to see just how is everything actually going to play out in the real world. And so with that, our next program is April 7th. And that includes a mortgage underwriter, a community association banker, and an attorney to discuss actual examples of how the Fannie and Freddie requirements are impacting community associations that they work with. In other words, what's happening in the real world. So you're all welcome to join us on April 7th. You'll get an invite to register for that as well.